Hello, I'm Naresh Neupane. This is a presentation about the financial analysis of 10 companies, selecting 5 from 2 industries each. Then I'll analyze each company depending upon different financial benchmarks. I'll also prescribe which company is best to invest in each industry category. Finally, I'll also suggest which one is the best company to invest among 2 companies from each industry. The financial analysis of a company and its comparison with other company in a similar or different industry can help us to bring a lot of insight about how the company is functioning in a given time frame. The major benchmarks for such comparison are liquidity, leverage, asset efficiency, market value, economic value added, enterprise value, dividend growth, and so on. 2 industries of choice are pharmaceutical and e-commerce. The 5 companies in pharmaceutical industry are Johnson & Johnson, Pfizer, Merck Co. Inc., Eli Lilly, and Bristol Myers. My 5 companies of choice in e-commerce industry are Amazon.com Inc., eBay Inc., Netflix Inc., Overstock.com Inc., and Blue Nile Inc. The pharmaceutical industry is not strongly positioned in terms of liquidity. Current and cash ratio for companies are 1.92 and 0.90 for the current year. This is relatively low. Current ratio for 2013 is highest for Pfizer, which stands at 2.41, while it's lowest for Eli Lilly, which stands at 1.47. Cash ratio for 2013 is also highest for Pfizer, which stands at 1.39, and is lowest for the Bristol Myers, which stands at 0.36. For the current year, profit margin is the average of 16.89%, which is less than the previous 2 years. However, EBIT has been steadily increasing. ROE for the current year is 19.44%, which is less than the previous 2 years. The debt of pharmaceutical companies is remarkably lower. The trend since 2008 until 2013 shows that debt is slightly higher than the equity, as equity multiplier is usually above 2, which is 2.18 average for 2013. The times interest earned is mostly above 20, which suggests that companies are capable for their debt financing. Interest expense is highest for Pfizer at $1.41 billion for 2013, while Johnson & Johnson has $482 million for 2013. The average return on equity for the selected 5 pharmaceutical companies for 2013 is 20.63%, which is mostly driven by leverage. The figure is fluctuating over time. Pfizer and Eli Lilly ROE is over 27, while Johnson & Johnson, Merck Co. and Bristol Myers have less than 19. The average price to earning PE ratio for 2013 is above 20, which is above the trend of the market. The market to book MB ratio for 2013 stands at 4. Any market to book value above 2 is considered overpriced. The highest price to earning ratio is that of Bristol Myers, which is 33.25. The enterprise value of a company is its asset minus cash and cash equivalents. The economic value added of a company is the actual return it earns after paying for the cost of its capital. The enterprise value of pharmaceutical companies stands at around 150 billion for 2013. Its economic value added stands at around 4 billion for 2013. Among these 5 pharmaceutical companies, our best choice for investment is Pfizer. Here are the main reasons. Its profit margin is 27% for this year with relatively low level of leverage. Its time interest earned of 11 suggests that it is quite capable of its debt financing. It has the highest current and cash ratio, while its return on equity is also the highest. It has the lowest market to book ratio. Its price to earning ratio is also low, which means it is fairly priced. Given its size being smaller than Johnson & Johnson, the largest American pharmaceutical company, its enterprise value is still higher and its economic value added lucrative. E-commerce industry is relatively new industry and is getting increasingly popular, as consumers rely on a lot of products and services based on e-commerce companies. Many such companies are proliferating. The liquidity of e-commerce companies is not optimal. Cash ratio ought to be more than 1, while current ratio above 2 or 3. The main reason for this is their high asset turnover. This table represents that the current ratio for this year stands at 1.328 in average, while the cash ratio stands at 0.722. Both of these benchmarks are decreasing over years. The profit levels of these 5 e-commerce companies is at record low. The profit margin for this year stands at 4.14%. Amazon.com Inc. and eBay Inc. garner the higher level of profit, yet their profit margin is comparatively low. However, earnings before interest and taxes has been steady for years, standing at 722.20 million in average for this year. Return on equity this year is very low at 3.21%. The equity multiplier for this year stands at 4.26, which is very high. Times interest earned for this year is 30. Owing to overpricing and skyrocketing markets of their stocks, all e-commerce companies have high price to earnings PE ratio as well as high market to book MB ratio. For the current year, price to earning ratio stands at 52.19, which is very high. Similarly, the market to book ratio for this year stands at 17.10. We have a clear picture that e-commerce companies' stocks are inflated. Economic value added for e-commerce companies is negative for the current year, which implies that these 5 companies' earnings after servicing their capital is negative. Their enterprise value are also lower because of their high cash retention. Our investment choice among these 5 e-commerce companies is eBay. Here are the main reasons. Its current ratio and cash ratio of 2.03 and 1.03 respectively for this year is highest among other companies. It is the good indication of the working capital of the company. Its equity multiplier, also known as leverage ratio, stands at 1.50. Compared to its size with Amazon, it has almost 4 times EBIT. Its time interest earned of 33.7 this year is also the highest, and it implies that it has no worries to service its debt. Its profit margin of 20.10% surpasses its rivals by wide margin. Its return on equity of 15% is less than its counterparts, largely because of less leverage and less asset turnover. Investment choice is clearly a subjective idea. An investor may have different preferences on different benchmarks. He or she may also have a trade-off of high risk for high return or low risk for low return. Pfizer is our choice for investment among pharmaceutical companies, while eBay is our choice for investment among e-commerce companies. To select between the two, we considered several benchmarks that made eBay to stand out. Here are the main reasons. eBay's times interest earned of 33.7 versus of 11 for Pfizer makes it a clear winner for debt servicing. eBay's profit margin of 20.10% and return on equity of 15% are remarkably higher, and it's sustained by less leverage. However, the profit margin of Pfizer is high at 27% because of low turnover rate and low sales. E-commerce is a growth stock and it has huge prospects ahead. Major trends are being set every day. Online shopping is increasing domestically as well as internationally. Thank you.